Hey guys, welcome back to the Capital Mindset Show. Hope you guys are having a great day out there. As always, we're going to talk about pool stock. So pool stock is a subscriber request, and without further ado, we're going to get right into the price action. Pool stock is actually not doing so hot. As of the 1 year, it is down 26.49%. If you actually see to my shoulder right around here, you can see that the P ratio is sitting at about 18.48. Market cap of about $13.33 billion. If you've never heard of this company, this is a company that focuses on building pools. Wow. So something that was a popular stock during the pandemic, Pool Corporation here, actually you can see from the lows of the pandemic all the way to its highs, it gained around 243%. Now, in a traditional speaking sense, you can see from before then, you can see that they are actually performing well. And all in all, they are actually up in totality by about 171%. Okay, so that's according to that 5-year performance. And that's starting off of a base of $120. Again, during the lows, you could have gone at $167. And from that peak to trough, they are down, let me see actually, they are down 42.30%. Okay, year to date, they are down 39.49%. And from this company, we have to understand, okay, what kind of customer buys a pool? Well, someone with disposable income, right? So someone with disposable income, probably some savings. And if we actually take a look, for example, how much it costs to build a pool, the national average is sitting at about $29,638. And if I zoom in for you guys there, you see that nice little family and the numbers there highlighted for you. Okay, so this is according to Home Advisor. The costs range from $16,000 to $44,000, with the national average being about $29,638. So safe to say that it is expensive relative to some people. Not everyone can afford a pool. Of course, the higher class can afford a pool. Middle class, high middle class can definitely afford a pool. Now, regarding the need for a pool, okay, so let's think about that. Well, if we think about this backdrop or this historical backdrop, what happened during the pandemic? Well, stay at home. People want more entertainment in the house. Maybe people are thinking about their upgrades. We saw a lot of increase in spending on home upgrades, and a pool is definitely one. I'll tell you a little bit of little backstory or understanding about Florida real estate. So in Florida real estate, at least we're in the area where I'm at, you actually would be very difficult for you to sell your house. Not impossible actually now because of all the people trying to move in. So scratch this for today, but back in the day, it would be difficult for you actually to sell your house, or a little more difficult. You wouldn't command as high of a price definitely if you didn't have a pool. So it's almost a necessity when you want to actually get the best value, and it actually is a value added in terms of what you could actually sell it for. So you would actually make more even past the investment of the pool when you were to sell your house. Of course, that does depend if you don't muck it up. You could always muck it up. But yeah, one other thing to note, we're going to also look at the financials. But before that, I want to take you over to the PowerPoint presentation. Keep in mind, please keep in mind, this is the sales pitch of the business. So this is their best foot forward, so to speak. And we're going to see what the business is basically saying to us as to why they're a good investment. You see, they start off with a very nice, beautiful pool. We're going to, of course, go over the financials because that's more important. But looking at the profile of the company, they're saying, look, highlighting our growth, we grew at 15% CAGR from 2016 to 2021. Please note that what happened in 2020 to 2021, they're probably going to or have pulled forward demand. Now, this is the first time I'm covering this stock, but it's not the first time we've covered stocks that have had pulled forward demand from the pandemic. That is more of a noob tier mistake that people can make if they don't account for that pulled forward demand, and you just assume that the growth will continue going forward and what that impact will have over the medium to short term going forward. Okay, so now if we look at the business mix, we do have the geographic markets, product application spend, so they're highlighting this to us, customer profile, network channels, markets. So with that, I want to show you the recurring revenue side of the business, or highlight it, product and application spend. In terms of it, we have maintenance and repairs 60%, remodel, upgrade 20%, new construction 20%. So this is their recurring business. Geographic markets, if we actually look at the United States, and the recurring business, by the way, is the maintenance and repairs. Similar to Otis. We haven't covered Otis in the past, but Otis, Elevator, and I don't know if Carrier necessarily has that strong of a one that I want to highlight, but Otis for sure, part of what they do is when they install that elevator in their facilities, you have to maintain that elevator over time, and that's the recurring spend that you get from the customers. Now, United States is absolutely the most important market for sure. This actually makes sense when you think about the demographics. Where's suburbia? United States is full of suburbia. Canada, it has it too. Europe's not as much. Europe's more city-centric, urban-centric. You won't have an abundance of pools like you do in the United States. I'd say United States and Canada are pretty crazy on that front. Now, we do have some of their recognized brands, so you might recognize them if you own a pool, if you've had someone build a pool, but, there you go. Now, I want to actually go down to these pie charts over here because I think they give us an idea of the business as a whole. So industry spend by characteristics, new pool construction actually only makes up 20%. Maintenance makes up 58%. So, that pool cleaning service, etc. Replacement and refurbishment is actually larger than the new pool construction, which is, I didn't know that, by the way, until I saw this. Now, discretionary spending, non-discretionary spending, they actually break it down by a category. So discretionary spending, when you want to build a new pool, that's a discretionary spend, okay? And then when you want to repair a pool, get accessories, equipment, that's somewhat discretionary, right? When you want non-discretionary, that's maintenance. So once you already have the pool, you have to maintain it. It's a non-discretionary spend. You don't want to let the pool go to waste. You want to let the pool become dilapidated, you have to spend on its continual maintenance. That's a non-discretionary spend. So remember, when we talk about the consumer in terms of the consumer spend, we have discretionary spending, and then we have necessities. So food, energy, housing, those are necessities. Discretionary spend, it's like, oh, I want this watch, I want, this iPad, I want whatever, these are discretionary spends. Now, I also want to talk about, well, they're actually highlighting it. I already mentioned this, the home investment trend. So they're actually capitalizing on it, or at least they're saying that they're capitalizing on it, and they think that it's going to continue. I don't think it's going to continue the way they think it might continue. Now, I want to also talk about they're talking about it. So new pools, higher value, energy saving features and technology. So basically they're saying people want to upgrade their pools now. Pools are actually becoming less costly from a maintenance cost standpoint on energy. And maybe this actually leads to upgrades in equipment, but that's a trend that they're kind of focusing on. I think they're going to capitalize well on that for sure, that I've had to actually make some upgrades as well. Now, if we're also looking at the product breakdown or the distribution breakdown, we do see that they have private label products, demand creation. No, that's not really what I'm saying, nor demand creation, like randomly in there, but product training, okay, warranty support. I think that's what they give to their, okay, that makes more sense, because I was like, what the heck are they even talking about here? Now, we do see gross margins, because we were going to discuss this elsewhere, but we'll discuss it here because we'll just kill two birds with one stone. Gross margins have risen, but keep in mind what we were talking about. Operating margins, same thing. We would want to normalize those. Net sales, again, massive drop. For what reason? Oh, I wonder why. We all know. And then diluted earnings per share, same thing. Same story here. Nothing new. Now, if we have a capital deployment, this is always something we have to judge a management team. We do see capital expenditure being 40 to 50 million range expectation. Acquisitions, 25 to 50 million. Dividends, 150 to 200 million. Share repurchases, 200 to 450 million. What do you notice here? I'm going to let you guys try to guess what you notice here. There's not a lot of CapEx. There really isn't. 40 million to 50 million is nothing. Acquisitions, again, it's almost similar to CapEx. Dividends and share repurchases, that's basically, they're like a cash cow. They're focusing on returning capital to shareholders. I'm going to take note of that. And when we look at the actual valuation, we're going to kind of determine whether or not that buyback or those share repurchases are going to be effective or not, or should they kind of wait. But if the share price looks cheap, we're going to get a good deployment there. So what we want to see here is the organic growth. So the organic growth takes into account the growth without the acquisitions. So it's just taking into account the current businesses that they own in their portfolio. Prior years or prior 5-year history, 5 to 9%. I actually like that they put that in there. Credit where credit is due, because just showing the 2020 and 2021 would be kind of misleading. They show you the prior 5-year. I'd actually probably say that that's going to be more accurate going forward, not 29% for the next long-term expectation. And again, growth contribution margin, again, I'd probably normalize that. And you see that the guidance actually slowing down. So they are actually being, I think, honest there. Longer term outlook, I think they're being honest all the way through. So I'm going to give them points there as well for honesty. Not honesty. They should be doing that. That's their job. So, it's expected of them. Let me just say that. If you thought that I was making an intentional remark saying, oh, it's great because normally they don't. No, it's expected they do that. So guidance is still expected to grow a little bit, but the reason why we highlighted this is when we go to the valuation portion, we're going to kind of pencil that out. What does that look like? But yes. So with all that being said, I'm going to take you guys over to the financials. We're going to look at the balance sheet and other form. All right, so taking a look at the quarterly statements, we're actually going to look at the balance sheet. So here we're going to kind of go through it pretty quick. Cash equivalents, by the way, it's in thousands, so that's 35 million. That's 35 million. It's increasing from the previous quarters. Receivables, this is money that's owed to us within 1 year. Receivables pledged under receivables facility, again, owed to us within 1 year. And that's receivables net, by the way. Product inventories, that's fine, it's inventory. Goodwill, they have been doing some acquisitions. We know that. Taking a look down below, I want to see that long-term debt. Long-term debt's been increasing. We're at 1.4 billion now. We were at 1.17 billion at the end of last year, and we were at 420 million a year ago. So from here, we're going to go to the statement of cash flows. We're going to take a look at something over here. We do see receivables being subtracted out and product inventories, but probably fine. Receivables is being subtracted out because receivables, remember, we haven't received that yet in the form of cash, so the cash flows are negative. But if I take us over to the 10K, we should see, and this is now the 10K, so you're seeing the 10K now. You don't see that same thing. You do see provisions for doubtful accounts, receivables net of write-offs instead. You don't see that receivables being written out totally like that because we presumably have received all of the stuff recognized within that year. Now, product inventories and receivables is still being written out on that, so it's a different amount. You can see it's not going to be to the same degree because you're presumably receiving a lot of that. So receivables is still being written off by about 79 million there. Now, product inventories, none of that's really matter. What I want to highlight then is the net cash provided by operating activities is sitting at 313 million. We saw the CapEx. The CapEx is basically nothing. And you can see there it's about 40 million, so it really isn't that big. And it is bigger from the previous years, but it really isn't substantial. There's not really much investment. They actually do a lot more in acquisitions, or about the same in acquisitions, which is funny. Well, I mean, both of them are small amounts. Now, if we do also see the debt rise, the debt rise has been for a variety of reasons from what I can tell. Some they were doing some return of capital, they were doing some acquisitions, some investments, a variety of things in there. Now, you can see the delta between the proceeds revolving line of credit, payment for revolving line of credit, that's still what's outstanding, but not really a concern. From here, let's go to the valuation, and I already took the liberty to plug it in. There is some videos coming out on the cruise liner, so keep an eye out for that. I'm going to be revisiting them because, yeah, why not? So with Pool Corporation, I want to highlight some things. It does appear as though they've kind of become cheaper, so to speak. Careful with that, but yes. So let's go back to this income because I want to actually highlight this. You can see that from a net income basis, it looks like it is cheaper than on a cash flow basis. Again, careful with that. I actually do think that what's going on is depending on how they recognize this income or how they do the services, do they get the payment up front or do they get the payment afterwards? Because the net income is going to reflect on accrual basis of accounting when they do the service. So as they do the service, they recognize it, and they may not actually receive all the money right then and there. It will probably go into the receivables section. But from what I can see there, we can see probably from the previous year how much was in that. So let's actually go to the balance sheet. And let's see if we can find the answer to that. So it does appear as though receivables have been rather tamed. So nothing like crazy jump because we went from 166 to 221. And then that's on that recorded day. Throughout the year, we've had different levels of receivables. So more than likely, it's just fine. So we're not going to really make a necessary adjustment. I'm trying to gauge how they're actually doing that recognition or how their business is working. Are they getting all the cash up front or do you pay in installments? How is it working on that? But I think we can just normalize it and we can account for that. So going back here, we're going to actually give it a nicer discount rate because we want a greater margin of safety. For me personally, I probably ask for a little bit more on this company. We are going to, let's say we give them the benefit of the doubt and they do perform that buyback of about 0.45%. Average growth, you can see massive growth all of a sudden. I would definitely not account for that growth. I would actually instead like to utilize a more tamed growth rate going forward. Remember that longer term growth rate average that they said. I'm going to say that because of the experience that they're going to probably get in the next coming years. I think that a 15% on a high front, on a high end, and then 12%. And oh, just so everyone understands, it's the reason why it looks so amazing is because it's this. If we, as soon as I took that away, oh, I didn't show you the parameters. So as soon as I took that away, yeah, it went away because I don't want to make that adjustment just yet. Now, cash flows are actually expected to rise drastically. Again, I think I'm kind of guessing that it's because of how they do their business or operate their business and get the cash that's owed to them. So cash might actually rise drastically all of a sudden into the future, but that's probably priced into that growth. So if we then assume that the cash flows are going to grow to that degree, in order to make up for it, we kind of have to pencil out somewhere close to like a 20% because then it starts to die down. And then, if I'm being honest, we should probably then normalize it. So let me see if I normalize it and then there we go. So I just wanted to normalize it real quick. We don't have to account for anomalies just yet because I don't think it's that drastic just looking at it. I think they're not too far away from trend line in terms of prediction. So we just normalized it, and from here, let's actually then start to make some differing assumptions. So I think that, again, 18%, 20%, let's move the 18% over here, 15% there. And on the lower end, I want to actually say that they get to that average, long-term average. So that means that we have a decent amount of deceleration here forward, and so that would imply that we have more room to the downside. I also have the implied moves here, and let me move you guys so you guys can see that. You can see the implied moves right over here. So if scenario 1 happens, we have an implied move of 51% to the downside. Now, if you look at analysts, just on the analyst measure, they have it at a strong buy rating of about $460.33, which does imply 38.27% upside. So if you're just here for the analyst take, well, there you go. Now, all in all, I think that this business, it's a good business. It's just, it got a little, not a little, but decently ahead of its skis. There was a lot of excitement. Now that excitement is dying down, whether or not it's going to continue is yet to be seen. We'll have to keep an eye out on this stock. I want to actually say that, there's a potential that, yes, there is continued demand. There is continued strength. Absolutely. Is it probable? Not in my personal opinion. So for me, I'd just be watching this company. If it ever proceeds to provide a good buy point for me personally, for me, that'd be in the below 300. So we're not too far away where I'd start to consider it. That's my honest take. All right. On that note, guys, thank you guys so much for watching, and I will see you guys on the next one. Bye.